Why is it? Oh, Swana was. Okay. Yeah. Thank you. Thank you for that. Now, the dollar index definitely violated that level. It's a monthly support level, very crucial level that we've been looking at very closely, where we've been going pretty much sideways for just over a little over a week, I think. When did we get the FOMC decision? I think it was last week, Wednesday. So
Okay.
yeah, just over a little. No, it's exactly a week now, basically. Exactly a week because it's Wednesday. Now we've just well, overnight during the Asian session, we violated that level. Now, of course, like I always say, role reversal, right? That was a key level. Let me change the color. We've been bouncing on it, then we violated it. What will be the next thing? Because we understand that if we violate support, this should happen, right? Then this is where we want to come in so we can push it further down. But that's not what's going on with the dollar index. It's really bizarre. It's doing its own thing. But we'll look into it. So those buys on Euro USD at this level were activated. Um, Still in them. The loss is not anything too hectic. But I suspect many would have been stopped out, maybe, when it comes to those buys on Euro USD. The only thing that seems to be holding up, which basically gives us what we call a mixed bag. This is where we lose that correlation, right? Because remember, when we have a weak dollar, we tend to see a strong gold. Are you following?
Mm-hmm. Yeah.
Now, it's not always the case, but in most cases, that is the correlation. We have an inverse correlation with the dollar and commodities. It's not just only with gold, but with commodities broadly speaking. If the dollar is weak, commodities go up, right? But in this particular case, we have gold that's bullish and the dollar. I think it's quite clear when it comes to the dollar why it's elevated. Can anybody give me that reason? Why are we seeing the dollar and gold move in the same direction, being bullish?
Okay.
No takers?
Mm-mm.
Okay, give it a guess then. We spoke about it yesterday, including oil.
Political instability.
Not quite economic stability, but
Political. Mm. No.
close, you're warm. Geopolitical,
Geopolitical.
right?
Okay.
Things are getting out of hand in the Middle East with that war. A lot of
Mm.
lives being lost. That definitely is a big concern for the global community. And we are seeing basically that risk of sentiment. I haven't looked at the Nasdaq charts, but I suspect that could be weak. Yeah, it is also weak. So this is where definitely we are properly risk off. We've got the dollar bullish and gold bullish, right? Remember, we've got three safe haven currencies. We've got the dollar, we've got the Swiss franc, and we've got the yen. Anything that causes some sort of uncertainty, we rotate out of riskier assets and we hold on to these, right? We opt
Mm.
for, in other words, bonds, right? Bonds are basically, when you speak about bonds, you can interchangeably speak about a currency, right? Remember, when it comes to, maybe let me explain bonds just in the simplest way. Um, it's a form of an investment. Now, there are different types of bonds. there's what we call treasury bonds, which basically are issued on behalf of government, right? We have corporate bonds as well, right? But the ones that we normally talk about are these treasury bonds. So normally when you have investments or you are actively trading like ourselves, but mainly investors, they will, hold on to a bit of both, right? If the sentiment allows to be risk on, if there's no economic uncertainty, we want to take on more risk, we would allocate more to the stock market and less to the bond market, right? And vice versa. Now, what these bonds are essentially are is you are lending out your money to the government, right? These are considered safe, or bonds in general are considered a safer investment vehicle because there's a belief, or yeah, I would say a belief that government don't usually default on paying you back, right? However, of course, the return on investment is not as exciting as stocks. You follow?
Yeah.
So, sure, you can own multiple bonds from different countries, but you usually would want to invest in countries which have a very strong economy and well, broadly speaking, they're economically stable, right? Uh, this is a form of what we call capital inflows. Remember, at the very start of our sessions, we spoke about capital flows, right? We said this is one of the reasons why money goes up and down or in and out of the country. So when we see a shift into bonds, it's basically, you know, capital flows as well. So people generally, or let's say investors and so on across the world would be interested in investing or holding onto US bonds. Why? Well, it is the largest economy in the world with a very sound, I guess, economy, right? So that's where that's one of the reasons why we would want to invest in the US bond market compared to, let's say, South Africa's bond market, right? There is, I would say, economic instability, mostly, caused by, I would say, political, um, should I say, interference or political lack, or the lack of political will for certain things to happen, right? So over the years, for example, South Africa, we've definitely seen a large capital outflow. Remember, all these countries are rated as well. Excuse me. Do you know some of these rating agencies?
Yeah, we do.
Name them for me. Some of them.
Um, what are they called again? Um,
There's mainly these two big players or rating agencies in the world. There's a couple, but there's two that stand out. I'll give you one. Maybe you can give me the other. The one is Moody's.
yes.
Do we know Moody's?
No, just hearing for the first time.
Right. So pretty much most African countries would be rated. In fact, pretty much the entire world. Um, you would find a rating by Moody's. It's basically, and there's another one.
Listen.
but they would rate a country based on economic stability, etc., etc., etc. And the higher the score, the better, because this is what investors globally would be looking at to know whether this is a place where they would like to put their money to work, right? So remember, there are various ways you can invest as an investor. If I am here, well, I am here in South Africa. Let's say I want to invest in, say, Nigeria. So there are different ways I can do, or I can go about it. I can invest in let's say, in a stock market, right? I can, let's say, individually pick certain companies, but the risk exposure is greater compared to investing in a stock index where I've got a basket of different companies, and I know that they, generally speaking, they wouldn't all do bad at the same time. So that index would, on average yield, decent returns. That is one way of going about it. Secondly, another way would be investing in a specific industry sector. Let's say let's say I want to establish a manufacturing plant of some sort, right? But that too has its own risks and rewards. If I'm going to be doing that, then I am, it's labor laws that I have to consider. It's security. How is the lawlessness rate in the country? And so on and so on it goes, right? I have to deal with human capital. I have to deal with living human beings, that I have to manage. So I can go about it that way, which then needs me to be actively involved in my, in the day-to-day, perhaps, of my investment. And then I can play it much more safer and say, sure, I'm interested in investing in Nigeria's economy, but I will invest, broadly speaking, and go for their bonds. So what I'm essentially doing is giving my money to government, and they then do what they need to do with my money. They can take that money and build infrastructure with it, etc., whatever they need to do with that money. And it is arguably safer, but of course the returns aren't, that big, but it's a safe investment vehicle, right? So yeah, that is basically what bonds are. Now, in this instance, whenever we have some sort of geopolitical event that causes some sort of instability or concerns, we say we opt for cash. Now, it's not physical cash, basically, it's just a rotation, because smart money or wealthy people don't actually get out of the financial market and place their physical money in a bank, right? So because, well, why wouldn't they do that? Maybe let me ask. Why don't they put their money in the bank? Well, the bulk of it anyway. Why isn't it in that form of liquidity?
Does they want more interest?
Yeah, sure. They do get more interest, I guess. That could be one of the reasons, but that's not quite why they are not opting to put their money in the bank.
Their money is not secured in the bank.
No, not quite. It's not secure. So, as an investment, as we all know, there is no such thing as a risk-free investment.
Yeah.
Are they not afraid to be taxed about it?
I beg your pardon? Raymond, try say that again.
Sorry, I was saying I didn't know that I didn't know that afraid of being taxed
Tax. You
a
say
lot.
that's correct. That's the answer, right? If you don't have your money in the bank, you don't have to declare that much, and therefore you're not liable for that much tax, right? And putting your money in the bank as smart money, or as in, somebody who's always concerned about um, inflation, or rather, yeah, let me say your assets beating inflation, because I get a lot of calls time and again from different guys and ladies trying to figure out what they can do with their money that's not being put to work. Now, not a financial advisor, but um, putting your money, of course, in the bank, you can only do that short term, right? You need to always find a place where it should be working and generating returns, right? So, wealthy people, that's why it doesn't matter what economic situation we are faced with. It's a very small percentage of those who would be, I would say, wounded by, you know, um, recessions, especially if the recession is quite severe, such as the 2008 one. But then I guess it also counts how big you are, right? How big your institute is, how big your company is. Uh, some organizations are too big to fail. So even if they were to fail, somebody's going to come to the rescue. And who's that? Any idea?
The government.
The government,
Okay. Okay.
right? The government will step in and bail you out because, well, you are Dangote, right? And geez, pretty much the entire cement manufacturing, the entire supply chain of cement on the entire continent, you pretty much run it. So it would be quite if the government doesn't step in to assist, save the company, save those jobs, because it would have a massive ripple effect in the economy, not just only being contained in Nigeria, but the entire continent likely. There's a lot of construction that relies on that cement, right? So yeah, but generally speaking, smart money doesn't really lose money, even in recessionary periods, because when there is a recession, they would simply rotate out of riskier assets such as stocks, and they would move their money into bonds. Now, it's not only bonds, and they don't completely shift out of the stock market. They basically just do an adjustment. So what they would do is they would maybe consolidate those positions from the big uh, uh, stocks, such as your Googles, etc., your Facebooks, the big companies, right? And they would opt for small, what we call small caps. So big cap is those big boys, right, on the stock market, and small caps would be not so popular companies, but that have very healthy and sound um, financials. And so they would rather invest there where there's a lot of potential for growth. But most importantly, they would be investing in what we call stable stocks. There are certain stocks that would generally do well under recessionary conditions. What type of companies or stocks do you think would do well in such conditions?
Consumers like food companies.
Exactly. Yeah, exactly. Mr. Bruno? We all have to eat at the end of the day, whether you lose your job or the economy is bad. We all have to eat. So those companies are generally going to be stable. They're not going to collapse, right? So your food companies, beverages, one that I really enjoyed the returns back in 2020 to 2022 was the pharmaceutical companies that I invested in. From your Adcock Ingrams to what was the other Aspen to I forget the other one. There were 3 or 4. People get sick during such times, right? When you're stressed, it will physically manifest itself as well. So you're definitely going to go to the doctor. So pharmaceutical stocks tend to do well. Alcohol beverages, I took a risk on that one as well. That did very well as well. SAB in South Africa, Miller. So those are the I wouldn't know if I wouldn't actually put alcoholic beverage stocks in staple stocks, but I think you get the idea. So, wealthy, smart money that would rotate into such stocks during uncertain times, right? So it's staple stocks and it's bonds, right? So that's what we're seeing currently today. We're seeing a sudden shift as this war progresses in the Middle East, right? Because on the economic calendar, the only thing that we had today was all inventories and excuse me. What else? What is it? All inventories and house and home sales, I think, out of the US. So nothing that would, really move the markets as they have done today. So we're seeing that risk of sentiment. And also what could contribute as well, largely to this, is I'm talking specifically about the appreciation of the dollar today. It would be profit taking. Today is the 25th. How many days are we left until the new month? Let's see.
5 days.
5 days, right? So this is likely profit taking. This is the last week also of so it's the last week basically of the month and is the last week of the quarter Q3, right? So for those who have been, say, bearish on the dollar for the entire quarter, now they're taking profit. I think let's switch screens and look at that dollar index closely. So Q3 would start, before we look at where it starts. What time frame am I on? Okay, let's look at it from the 4-hourly. Okay, there we go. This was July 2023, December 2023. Remember this movement here, this week was rates in the US by 50 basis points. This should have definitely closed below, give us a role reversal and continue to the downside. Are we all understanding it that way?
Yeah, we are.
Right? Above, basic low, role reversal, as you can see, I had that placed. That didn't happen. And we are basically above bullish territory again. So honestly, for those swing trades, it hasn't been pretty much easy since last week, Wednesday. So the only thing you can do is play tactics and scalp it and not really commit to those short to medium term trades. Okay, so let's look at Q3. Q3 would have started when? June, July. It's July, August, September, January, February, March, Q1, April, May, June, Q2, July, August, September, Q3. So July, where are you? July. I'm going to mark it out with a vertical. Bears have been holding onto this move for the entire quarter. And if the dollar has been doing this, GBP USD, Euro USD, gold, Nasdaq, Dow Jones, what's happening today? What direction would they be taking? Hmm? If the dollar has been bearish for 3
Are we
months,
buying?
it would be
Bullish.
right. Definitely buying. So those who have been in this move, it's month end. Like any other business, month end, you take profit, you tally up, right? You're balancing at ledger. So that could definitely be what it is too.
Yeah.
Any question?
So I guess it's a wait and see where it's going.
Pretty much. Remember, I said the hardest thing also for traders to do is sit on their hands. You always want to engage the charts. You want to click on that buy and sell button, always. And that's where you get hurt, right? So let's exercise patience. We will get, of course, those quality trades. But if you can't, like me sometimes, then look for those scalping opportunities, but manage your risk. Let's speak about that level. Taking into this point before we continue lower, hard to say, but we would need some sort of catalyst, right? Maybe if this war really intensifies, we would definitely see that positive correlation moving zone. Let's see. But of course, moving averages, use your trend lines in, right? Or violate to the upside. I think it would be quite easy to conclude that bulls are in charge.
Yeah, I drew this as well on mine this morning. Exactly the same thing.
Beg your pardon?
I said I drew this as well on my chart this morning.
Oh, yeah. Nice one.
Yeah,
Well
exactly the
done.
same.
Well done. So let's see. Let's quickly switch back to MetaTrader. The only one for bulls. Oh, before we actually move on gold. Remember we had those pending buy orders, 24, I think, 26.48. It missed it by a few pips. Said I was in front of my PC, so I couldn't manually execute those trades. I think it would have been an easy buy if I was looking at that chart, because I would have seen market exhaustion and I would have definitely, bought into this one. Yes, arguably this is 26.55 is resistance. We have bounce off there, but I would have been an aggressive bull. In other words, buying into a trade that didn't potentially, or how can I put it, with less profit potential because of that level. But of course, risk management always needs to be applied. So that would have played out well. Maybe this is what, 100 pips or so. Okay. Yeah. So we missed that one. Euro USD. We already seen exactly what's going on. I think anybody who's a bull maybe might also be interested in this one. I think a close above the zone would suggest bulls are in control yet again. Hard to say. We'll see how it plays out. GBP USD. GBP USD. Not convincing, yes. In the previous hour, market exhaustion, right? In the previous hour, market exhaustion, but there is some downside risk to this, as we have observed a rather bullish momentum on the dollar index. So this is not convincing for me. I think I'd like to see how the hour would close, maybe even 2 hours from now. Are we closing above, or are we definitely going down, right? I think a close below this, I might entertain those sells, a close below the previous low hour, right here. That's where I would go into those sells. and I know we are likely coming into the zone here. But of course, if we close above, then we'll entertain those buys. But like I say, there is downside risk because of the bullish momentum that we've just observed on the dollar index and its month end. And we can see that that bullish momentum has been lost. We do have a convergence happening between that 25, or rather that 55 and 20-day moving average. We did moving averages yesterday, am I correct?
Yeah.
Yeah.
Yeah, and
Yeah.
coincidentally, it's actually still in a trend line. If you draw the 4 hour, even the 4 hour and the daily,
Yeah.
it's on a trend line that's at the verge of breaking out as well.
See? So now we've already violated the 21 on the 4 hour. And like I said, we're coming into the zone, which coincides also with that 55-day moving average line. There's a high probability we're going to come in and test that. So if you were to ask me personally, I am my bias lies in bears in terms of or rather, let me put it simply, my bias lies in dollar bulls for now. So GU, EU, definitely bearish, right? But price action will dictate exactly where we're going. Nasdaq also has come to test and has been going sideways maybe for about an hour or two. See that? So of course, I mean, logically speaking, where's that pen again? Who's here? Is it bulls or bears?
The bulls are there.
Bulls are here, right?
Bulls.
Bulls.
So if you are a bull, this would be a favorable place for you to buy, right? If you're a bear, definitely you want to see a close below, right? Because you were supposed to catch those sells there. So you're a little late, you would have to wait your turn. Bulls right now are negotiating that push to the upside. Right? That's pretty much a review on these charts. Dow Jones finally taking a bit of a breather from record highs, and I suspect German DAX also doing the same thing, also down in the day, right? So let's go back here. There we go. Let's look at the economic calendar. And yeah, like I said, we only had out of the US new home sales. That's down from 751 to 716. Medium impact, that should have actually brought the dollar up or down.
I think up because it's higher than expectation. Even though it's down, but it's higher than the forecast.
Yeah, well, I get it, right? I get the logic behind it. Makes sense, right? And this is data that I don't like engaging, to be honest with you. I engage two types of data. Surprisingly good numbers or disappointing numbers.
Number, yep.
Right? It needs to be hard facts. So the prediction, or let's start first with what it was previously. 750, the prediction was 699. Yes, we got better than the prediction, but honestly, this is worse than last month. So what do I mean by surprisingly good numbers or disappointing numbers? A disappointing number for me would be a number that is, number one, less, right? Less than the previous, which is what we have, but also less than the prediction. That's a completely disappointing number. Are you following? Am I making sense?
Yes.
Right?
Yeah.
That data is easy to engage. There's Nothing confusing about it. It is worse than the previous month and it's worse than the prediction. It's an easy sell for that currency. It's disappointing. A surprisingly good number is when we beat the previous month and the expectation or the forecast or the prediction, whatever you want to call it. That is also easy. We know that we have to buy. With such data, this is where you get that, I would say, volatility, where we lack direction in the market. So, if anything, the data, this is the type of data I wouldn't have engaged. Now, it's medium impact. Home sales aren't the biggest data set right now that really moves the market. It does, contribute to formulating our bias because we can engage with this data like any other economic data that pops up here. It helps us to gauge the economic health of that country. But home sales currently doesn't make headlines, right? It doesn't have a lot of market reaction, if I can put it that way. Okay. The biggest data right now, right? And this changes from time to time, right? The biggest data that moves the markets right now. Let's jot it down. Let's hear from you. What would move the market? What type of data moves the market? Be it any currency.
Interest rates.
Interest rates. Interest rates.
CPI.
Say that again.
CPI.
CPI.
Polit-
Did you say COVID?
Political events.
Geopolitical events, sure. But this would be headlines, right? I want economic data, but I'll put it
NFP.
there. NFP. CPI.
PMI.
What does CPI stand for?
PMI.
PMI. PMI data. Purchasing Managing Index.
Consumer Price Index.
Consumer. What is it again? Let's just help out maybe those who don't know
I
what
think it's Consumer Price Index.
Consumer Price Index. Okay.
That's CPI.
Yeah. And what is CPI? What's CPI? What does it measure?
Price index measures the buying power.
Not quite. You're close.
Inflation.
Yeah, I wanted that word.
Inflation. No, okay.
You're right, because
It's just the grammar.
you're right. It speaks to your buying power, right? Inflation. But I wanted that word, inflation.
Wanted inflation. Okay.
Yeah. Tell me, NFP. What is NFP?
Non-farm payroll.
Non-farm payroll. And what is it measuring?
That's the how would I put it now?
The labor market.
Outside of agriculture, like that, it measures the what's the word? It's not coming to my head.
I think somebody
Labor.
said it, but
Measures
the line
something
wasn't
outside of agriculture.
Somebody
You laugh.
shouted it. I think they said it, but the line wasn't clear.
Oh,
Who come try
Is it labor?
labor,
Yeah, I said the labor market.
the labor market, right? Labor data. That's important. PMI, Purchasing Managers Index. Yeah. I'll put it in there. When we talk about this, we tend to PMI. That tends to be split into two. What are we measuring?
FOMC.
Okay, well, yeah, 100%.
There is PPI as well.
What is that?
PPI.
PPI.
I think I also have on GDP.
Yeah, I was waiting for that one. GDP. Let's see. For interest rates, we've got CPI, geopolitical events, NFP, which is labor data. PMI tends to be manufacturing. And what else?
Services.
And services. Helps us definitely to measure. So FOMC, yeah, sure. One of the biggest. But it would also fall under basically, let's say central bank decisions. This is the worst mouse ever. But you get it, right? Central bank decisions. I gave up on trying to write with this thing. Central banking decisions.
Get an iPad. You write it to pen easily.
Yeah, no, I'll wait to get it as a gift.
Like me.
I have trouble parting with money of late. But yeah, a topic for another day. Central banking decisions. Now, I'll tell you one thing. This one here, central banking decisions, are formulated because of all of this. Right?
Yeah.
Are formulated because of all of this economic data. So central banks are looking at this data. This is the data that they're using to gauge whether the economy is moving too fast or too slow, and then they would know how to adjust or tweak their central bank.
I think JOLTS also falls in there.
What is that?
Jobs opening, JOLTS.
Yeah, jobs opening. Yeah. So let's say, broadly speaking, let's say labor data, right? Let's say labor data. And we are yet to break it down very nicely for everybody to understand, right? But like we always say, Forex trading is beyond what many understand it to be. Most retail traders, they are that ordinary driver on the road going up and down in a car. But you here are not an ordinary trader. You are that driver who understands the moving parts of the vehicle that they're driving. Right? They understand what actually makes this car move forward and backwards, what makes it accelerate, right? So they don't just go into a car and drive. When they're asked what is an injector, what is a cylinder ring, a piston ring, etc., they know those things. You follow?
Yeah.
So you understand all the mechanisms of the vehicle that you're driving. And this is basically what fundamentals are. You understand the moving parts. This here are those gauges in the car that give you information about what's going on in your car. It's your oil level. It's your speedometer. It's your rev counter. It's your water gauge, etc., petrol gauge. You follow what I'm trying to say here? Because with those gauges, I mean, for example, if this was your petrol gauge, if you are not getting feedback or you're not getting this data, you're doing guesswork, right? Because you can't stick your finger inside the petrol tank. It won't reach. So you are going on guesswork here. When you drive from point A to point B, you're saying, nah, I put $20. I think the last time it took me 100 kilometers, I think, yeah, if I drive at this speed, I just might make it, right? So it's guesswork. You're driving blindly, right? But if it works, you know exactly that this is the amount of gas I have in my car, and I know I can reach this destination. You follow? So those are those gauges that the central bank needs in order to make informed decisions on their policies, right? So because we understand what is important at a particular time, because the central bank will always tell you, we are able to move in the direction or that they are trying to take the economy. We understand exactly what their mandate is, right? And because we understand what their mandate is, we simply just have to understand or monitor these gauges, right? And we know, okay, they're moving in the desired direction, which has been set by the central bank. This is what it means for the currency. Or it's moving in the opposite direction. This is what it means for the currency. This is what the central bank is likely going to do, right? So let's talk about, monetary policy.
Before you do that,
Yes.
Label, the NFP, what does it demonstrate?
Labor, the employment data.
What about labor? Yeah.
So different, countries will call it something else. But essentially what NFP is, it's looking at employment by, or let me say public servants. Let me put it that way. Right? So leading up to basically NFP, we've got, data that comes out, private employment, etc., private sector employment, this, and that. But NFP, non-farm, so they're saying everybody except farmers. That is basically the public sector, right? So we're looking, we get 3 data sets on NFP. What is that? For anybody who knows? So we get
jobless claim.
That is before NFP, but under NFP itself, there's 3 things that we are looking at. So it's employment created for the previous month. Okay, so it comes out basically every first Friday of the new month. That's that day. Every first Friday of the new month. This data has got a lot of market engagement. It is the lottery of trading, if I can put it that way. There's a lot of hype behind it. There's a lot of attention paid to this data, right? So it is employment in percentages, or not a lie. We get it in terms of numbers, how many jobs created. So let's say on the first Friday of October, we will be getting employment data or NFP data for September. How did September fare? How did it perform? How many jobs were created for the month of September, right? Is it 100,000, 300,000? There will be a projection as usual. So we're looking at that in physical numbers, employment. What else do they give us? There's 2 more to go. Unemployment rate. Right? Unemployment rate.
Okay.
What is the unemployment rate currently in the US? I think it's 4.2. We can quickly check.
Yeah, it's 4.2.
Right. I love this website, by the way, Trading Economics. Any data you can think of, hardcore data, macroeconomic data, you can find it here much quicker and easier. Forex Factory, which is loved by a lot of retail traders, doesn't quite cut it for me, right? So on the homepage here, if looking, 4.2, that's what it is. Where was I? Yeah, 4.2. The previous month, it was 4.3. Okay. Where's the pen? So we get unemployment rate. And lastly, we get, anybody?
The NFP itself.
This is NFP. Good try, though. This is... you see, maybe you forget it now. Oh, yeah. Weekly average earnings, I think it's called. Weekly hourly earnings. Yeah, weekly hourly, I think it's called weekly hourly earnings or wages. Weekly hourly wages, something like that. Essentially what they earn, right? So what we want to understand is, did employment go up? Did the unemployment did the employment go up? Did the unemployment go down? Did people earn more? Right? Whatever it is, it can come out either way. But what would signal a strong labor market? It would be an increase in employment, of course, a decrease in unemployment, and an increase in what people are earning. Of course, if you engage in the dollar, it's positive for it.
Okay.
Right?
Okay.
It is positive for the dollar. Now, it can be confusing. We can have employment rise for the month and unemployment also rise.
Right.
Does that make your head sore?
Yep.
You start to scratch your head at the man, how do I engage it? No, it happens. Some say, but now how can we have an increase in employment and an increase in unemployment? How does that work? Does anybody have an explanation?
No,
We are waiting for you.
Yeah. You see, I like to ask, I don't just keep on blabbing and talking because I want you to use your medulla oblongata, right? Okay, let me give it to you then. So let's say we have a population of, let's say, 100,000 people, right? And a survey is conducted every month. Let's say 100,000 people, all of them are unemployed. Let's say this is the worst case scenario. Or rather, no, let's do it this way. A survey was conducted on 100,000 people. That's the population. They were asked, are you looking for a job? Are you not? All 100,000 people said, yes, they're looking for a job. What would be the unemployment rate in percentage?
100%.
100% unemployment rate, right? 100% unemployment rate. Now, they come back again and they ask them, all 100,000, who's looking for a job? Who's not looking for a job? And then say 10,000 say, they are no longer looking for a job. What is the unemployment rate now?
90%.
90%. Now, those 10,000 who said they're no longer looking for a job doesn't necessarily mean they are under somebody's employ.
Yeah.
It just simply means that they're no longer
I'm no longer looking for a job.
a job. It could be for various reasons. Maybe somebody's not healthy to work anymore. Maybe something happened, or they simply just gave up on looking for a job. And so when you actually give up on looking for a job, you are no longer counted as unemployed. Are you seeing it now? So those 10,000 people doesn't necessarily mean now they're part of the labor force. And this is something that I always say with South Africa's unemployment rate, especially for the youth. It is well above 70%. So it's distorted because the youth has given up on looking for a job. Right? So it is not at 40%. You just simply have to drive around in the townships to see how busy they are. People are just loitering everywhere. Everybody's just around. The neighborhoods are busy during weekdays. And if they were employed, it would be quiet as I remember it from my childhood. Right? The only people that you would see are people who are not eligible to be working, which are school-going kids. Those are the ones that you see around the streets. And then come 4 p.m., 5 p.m., the traffic starts to build up. People are coming back from work.
Yeah.
Now, it's different. You follow? So, unemployment rate, you can have your employment go up and your unemployment rate also go up because somebody out there then decides, okay, I'm actively looking for a job again now. And so that pushes the unemployment rate up. Now, also, you must remember or understand rather that every country has got a natural rate of unemployment. Right? Where they say, no, this is normal. This is the average. This is, it ranges between 4 and 5%. For some countries, it might be, it ranges between 1 and 2%. There are such economies, right? And then maybe for some, it's normal. It has become normal for us. No, it ranges between, I don't know, choose a number. I don't know. Right. But that's what it is. Maybe, yeah. So for some, maybe it's 40%. Okay. So, yeah. Is it all, are we all understanding now this NFP data?
Yes,
Okay.
I do.
Yes.
Okay.
Thank you.
So
Thank you.
we are still going to engage it again because we've got NFP coming up and we have to understand its importance thoroughly and what it means to traders, investors, basically, market participants, what it means to the central bank, because labor data is extremely important right now. It is one of the biggest themes in terms of macroeconomic data. Remember, I said the theme changes from time to time, right? But the biggest theme right now has been inflation, has been labor data, has been interest rates in most developed economies, right? In most developed economies. So we're going to speak at length about inflation And the largest or the monetary policy tool that takes the spotlight here, which is basically interest rates. So interest rates is one of many monetary policy tools that a central bank has at their disposal, right? There are various tools that they can use to effect a particular change in the economy. But what monetary policy in plain English is, it involves the management of money supply and interest rates by central banks. Now, I could have spoken about any central bank when I was putting this small PDF of 2-page. But I chose the Fed because, well, it is the central bank of the US. It is the largest economy of the world. What happens in the US would have a ripple effect on the global economy. So if you want to understand the markets, the financial markets, you want to keep a close eye on the largest economy, which is the US, right? So the Fed, who is the Fed? It is the Federal Reserve Bank of the US, right? And by the way, how many central banks do you think the US has? Or maybe, yeah, let's start maybe here with South Africa. How many central banks do we have here in South Africa? Sounds like a trick question, eh?
Yep.
But one,
Is it that one?
We
but
have.
one,
How many do you have?
One, of course. I want central bank.
You have one. Okay. By the way, our central bank is not owned by us, right? We
Yeah.
don't control the printing of our own money in South Africa. Do you know where we get our money from? Where do we order it from?
Nah.
Many people would think, of course, I mean, the central bank, you know, the central bank, right? They're the ones who would print the money, but not us and many other African countries, by the way. Right? So we get our money from London.
Oh, really?
Yep. Our South African rands, we get it from London. Yes, sure. I'm going to be sharing these PDFs and a whole lot more with you. Yeah, I was just responding to a chat there, message. Yeah, we don't print our own money. We basically order it. I think the only thing that we would physically mint are the coins. Our 5 Rand coin, 2 Rand, 1 Rand, 10 cent, 50 cents, 20 cents. I don't think we make 1 cent anymore. Yeah, those we make them in our capital city, Pretoria.
Does that apply to all African countries or just Africa?
No, not quite. No, right? But yeah, very few would actually print their own. I'll prove this with the scandal that happened a couple of years ago in South Africa. So a plane landed at our biggest airport, of course, our international airport, or a Tambo. And this plane basically was from London. And it had probably about, I don't know how many crates, pallets, right? Not crates, pallets, that would, be moved with a forklift, which were basically billions of rands, nodes, currency with billions of rands, South African rands, right? So this plane landed, and a few guys who worked in customs, this is some movie stuff. Somebody needs to make a movie about it. they've been working there for a couple of years. They knew the ins and outs. They knew what's in what plane, coming from where, what it had, and they basically made that money disappear. The bulk of it, anyway. And it was such a smooth operation that it caught everybody by surprise. You can imagine how secure that airport is. I mean, we've got so many police, personnel at the airport there, but they managed to get away with billions. They made it disappear. And it was a clean job. But unfortunately, someone got silly and couldn't wait for the dust to settle or the heat to cool off. And they basically bought a Lamborghini. They spotted them. And they said, no, man, this guy usually drives a Toyota. I saw him on the highway. I know this guy. I saw him. And he works for customs. So that's how. Otherwise, it was done. They couldn't figure out who it was. Yeah. So that money comes from London. So basically, let's say 100 Rand bill, paper note, we basically would pay, right? Because it's not for free. So we're basically buying our money from the UK. So let's say for $100 bill, maybe it will cost our central bank, let's say 10 Rands. But of course, it's not Rands, it will be pounds. Maybe it will charge us, let's say, £2 to mint that 100 Rand bill. So it's a form of taxation that we basically are paying to the UK. And I think many would understand or know that we are a former British colony. So this is with a lot of these former French British colonies, they pay what is known as civilization tax to France. And you know who's undoing all of that, right? We have Traore. Is it Traore? Yeah. In fact, the youngest president who's changing things up. But yeah, let's not deviate too much. But basically, we have.
now you get taxed a lot.
So a lot of that's how deep the
What?
yeah, it goes, right?
30 years later, why are we still doing that?
30 years later. If you look hard enough, it is the political will. If you've noticed, there's every time we have a president who's inaugurated into power, within a year or two, they do a state visit to where? To London to go and see who? Well, they used to go and see that short granny.
Yeah.
Now she's gone, so they're going to see King Charles now. So they're going to go see the master. Say, hey, listen, remember, how are things going there? Protect protect our interests. You know what you do. This is how the game works, eh? Don't mess it up. Right? Don't mess it up. We control everything, basically. You just have the political freedom to vote, but you don't have the economic freedom that you think you have. And if you dig deep enough, you will actually know that we actually have a company number. We are listed as a company in their books. They don't really see us as a country. And a company must yield what? Returns. It's deep, this thing. So yeah, we have one central bank, but not the US. The US has got 12 central banks.
Wow.
The Federal Reserve is the reserve of the reserve. Right?
Okay.
So it speaks to the history and of the US, and also its landmass. It's a big country, and it used to be divided. It used to be, of course, it's still considered the land of the free, but it's got 12 states, and these 12 states almost run. They used to run, let's say, independently, but it became a problem, and basically the wealthiest people out there came together secretly, as usual, to form, the Federal Reserve, right? As we know it today. Yeah, like I always say, what you don't know doesn't exist. So now you know. So the Federal Reserve oversees all these central banks, which is in each of these states. Philadelphia, New York, you name them. I think, yeah, right. Texas, etc. goes on and on and on. These 12 states. So you have the Reserve Bank of Philadelphia, New York, you get it, right? And then we've got the central bank, or the mother of all of them, which is the Fed. So now, with the Fed, right, I think we should open the website quickly. If this thing will allow me. Okay, there we go. Oh, by the way, I see our president is in New York meeting up with our homeboy, Elon Musk.
Yeah.
He's trying to sweet talk him to come back home. It's not gonna come back home to invest. So he's not gonna come back home. The structure of the Federal Reserve Reserve System is what we want to look at. So the FOMC is the Federal Open Market Committee. Where is it? Why is it not opening? You want to allow me to select? Okay, let me just click on about, and hopefully it will take me there. The FOMC basically has got usually 12 members, right? Which is a Federal Open Market Committee, usually has 12 members, one from each state. And so far, it's not a full staff complement. I think we have how many? 1, 2, 3, 4, 7, right? These are the guys and ladies who, look at the data, debate and deliberate upon it, and vote on what decision needs to be taken. Jerome Powell, he's the chair, the federal chair. The vice is Philip. Now, Jerome is the guy who takes the heat. He's the guy who, time and again, will be sitting in front of the panel of Congress, which is basically government in parliament. And he gets to answer very difficult questions on decisions taken by him and his department on the economy, right? He doesn't make the decisions on his own. These decisions are made on consensus, right? Majority rules, let's put it that way, right? So that is the FOMC. These are the states here. Federal Reserve banks, all 12 of them. San Francisco, Dallas, Kansas, Minneapolis, St. Louis, Chicago, Atlanta, Richmond, Cleveland, Philadelphia, New York, Boston. Right? You have time, just can come to the About page. You're going to be spending a lot of time in this website. At first glance, comes across as intimidating because some of you have never visited a Reserve Bank's site or central bank site, but it's not difficult at all. You will learn the jargon, the central banking speak or lingo, and it will make sense. Spend time watching Bloomberg and other, alike shows, right? Or podcasts on YouTube. I spend a lot of time just getting people's different opinions, but not just anybody, of course, because everybody claims to be an guru of some sort. I'm not talking about what retail traders consume, right? Which is, just a scratch on the surface. No, you want to go a little deeper, right? So, fine, a central bank, its mandate is to carry out the monetary policy, not the fiscal policy, right? Fiscal policy, who's in charge of that? Fiscal policy. You will always hear monetary policy and fiscal policy. Who's in charge of fiscal policy?
Government, right?
I beg your pardon?
Government.
Government. You're 100% correct. It is government. What is fiscal policy? Maybe you might ask. It's the day-to-day running, basically, right, of government. If I can put it simply, I do have a PDF that I'll share after this, which would explain it better. Taxation falls under fiscal policy, right? Creating conducive environments to stimulate the economy, that's the responsibility of, government. Yes, and sure, the central bank under their monetary policy, but I'm talking, they would take, of course, how they spend as government would affect the economy one way or the other. So if they want to stimulate growth in the economy, would they tax you more? No. If they want to stimulate growth and increase potential capital inflows into the country, they need to relax those taxation regulations. Does that make sense? For example, if I'm going to invest in the US, and they're saying, listen, when you want to repatriate your funds back to whatever country, or you want to withdraw your investment or your capital, we're going to tax you 40%. Maybe hell, maybe even more. That's not enticing for me. No. I'd rather go elsewhere. Let me go to Abu Dhabi in the UAE, right? Where it is almost tax-free. In some cases, it is tax-free. So I'd rather put my money there, right? Let me go and put a nice skyscraper there, and yeah, have a good time. So government is responsible for such as well. They play a major role in stimulating the economy, right? Social welfare is not the responsibility of a central bank, but government, right? So social welfare, of course, needs money. Where would that money be coming from? It could be coming from their state-owned enterprises. We have the likes of, electricity producers, which are not working that well. We've got Eskom, we've got, PRASA, which is our railways. We've got our airline, SAA. And it goes on. We've got Denel, just to be the best in the world. It's an arms manufacturing company. We are known for our R5 rifles, R4, so many Armored vehicles, we are known for, what is that helicopter that is known all over the world that can do backflips and stuff like that? That can, yeah, right. So these are state-owned enterprises which yield, well, are meant to yield massive profits. And that money, of course, then can be used to finance various things. So social services can be funded through taxation, of course. And if there isn't enough money, then they have to borrow money, right? They have to borrow money. Where would they borrow money? Well, we know with African countries, the World Bank, International Monetary Fund, for many African countries, it's a big trap, and many have woken up.
China.
I beg your pardon?
They borrow from China too.
Oh yeah, no, China is the big boy, on the ground lately. I think many would remember the scandal with Kenya, where I can't remember what happened, but basically they defaulted on their payment. It was a couple of years. They just simply couldn't pay it back, and so I think the Chinese government basically now owns or were eligible to own the airport.
Yeah.
Key, it's a key infrastructure. It's a national, what do we call it? A national
key point.
National treasure.
Yes, national key. What? You just said it, maybe no.
National key point.
Point, right? That's what it is. So, yeah, it can go to such lengths, but with the US, and of course also with us or any other country, your central bank can print money into existence, right? They can print money into existence. Now we have basically then the issuance goes back to that point earlier. The government would then issue bonds via treasury. So they will basically say we have X amount of bonds. And by the way, yes, I said there are different types of bonds. I said corporate and government. But when it comes to government, there's also different types of government bonds. We have 1 year, we have 2 years, we have 3, we have 4, we have 5. I don't know if there's 6, 7, 8, but I know there is 10, and then there's 20, and then there's 30. I think this is pretty much where it ends, right? So I get to choose as an individual, as a country, as a company, whatever, what type of investment I would like to make, or what type of bonds I want to buy, right? So these will be issued out, and depending on the economic conditions, these tend to be very attractive or not so attractive. People say, so not many might be taken up, right? But I would say concerning, or how can I put it, under unique circumstances, but not entirely new circumstances, such as recessions, it wouldn't be just you and I be buying these. It would be the central bank actually buying them from government, so that the government can have that liquidity to fund the crisis, right? To alleviate the effects of a recession. Of course, people lose jobs in a recession, and when they do, they will go and claim for unemployment checks. That's where government steps in. So during the pandemic, a lot of people were told to stay home. Some lost jobs. And so if you're not working, you're not earning, you start to claim for that unemployment check. And at that time, actually, They were giving out every other week $1,800 every other week to everybody who's staying at home, which was most of the population. Right? So they were able to fund such by issuing those bonds, which were bought by who? The Federal Reserve. But there is a side effect to doing so. What is the side effect?
Inflation increases. They become much plenty money in supply.
You increase the money supply, inflation starts to rise. Now, it doesn't mean, dear traders, that when you increase the money supply, you will always get inflation. Or rather, let's say, runaway inflation, uncontrollable inflation. No. You only get uncontrollable inflation if the aggregate demand, you will always see that, so I will mention it now, AD, aggregate demand. When aggregate demand exceeds supply, that's when inflation will rear its ugly head. Okay? So when demand for goods and services increases, is met by supply, inflation remains stable, right? Yeah. But if there's 10 people chasing one product, inflation, the product value goes up because there is less of it. Is that clear?
Yep.
All righty. So, fiscal policy, we have an idea. Monetary policy, these are some of the tools. Now, it's pretty much similar, if not the same, across other central banks. They've got the discount rate, the reserve requirements, open market operations, and interest on reserves. Right? There's something big that China did yesterday. They cut this one, I think by 50%, reserve requirements. I'll explain it. And so what it is basically, or rather, I'll get to that point, but these tools here can be used in a expansionary way or in a contractionary way. What do I mean? Expansionary would be, and there are many words for the same thing that are used interchangeably. You will hear economists say expansionary. Is it A? Hey, forgive me. Expansionary. They might say accommodative. Right? Accommodative. They might say dovish. Have you heard of this term, dovish?
Yeah.
Mm-hmm. This is when anything expansionary, accommodative, dovish is when it's directly correlated to economic growth, increasing demand, right? Stimulating economic growth. Let's put it that way. The opposite of that, of course, would be contractionary. I always say if you ran away from school and you thought Forex is going to be easier, back at school, eh? Get it. Somebody I know they're thinking, shucks, what did I get myself now? You see now.
Yeah, I thank God I did economics at at A level.
You shoot yourself in the leg.
You need to give yourself a pat.
Yeah, no, I thank God I did economics, and I had an A in economics at A level.
Yeah. I
So I'm just watching. I'm just watching.
yeah, yeah.
Yeah, no, but I'm on point. I'm on point.
Thank
It's
you, sir.
coming back.
Thank you. It's all coming
Yeah,
back. It's all making
yeah.
sense. Yeah, no, welcome back to school. Contractionary. um, you're gonna hear what's the opposite of accommodative? I don't know what would that be, but it's contractionary, it's restrictive. Restrict. Oh, like I told you guys, this pen restrictive. And the opposite of dovish would be hawkish. Now, the ones that are used quite a lot is this ones here, right? You're gonna hear
Yeah.
dovish, hawkish, and you're thinking, well, what are they talk? Why? What are these birds? Because they only just said bulls and bears. Now they're talking about doves and hawks, right? So yeah, you tend to hear these quite a lot, right? So they can use these tools to either be expansionary, dovish, in other words, or to be contractionary, which is hawkish, right? So let's go over them briefly. The discount rate is the interest rate reserve banks charge commercial banks for short-term loans. The Federal Reserve lending at the discount rate complements open market operations in achieving the target federal funds rate, right? So this discount rate basically affects this one here, which you always, which is the one that we just simply call interest rates or Fed funds, right? So lowering the discount rate is expansionary because the discount rate influences other interest rates. Lower rates encourage lending and spending by consumers and business. Likewise, raising the discount rate is contractionary because the discount rate influences other rates. Higher rates discourage lending and spending by consumers and business. Discount rate changes are made by reserve banks and the board of governors, right? So I think it's quite clear, but is there any question, any clarity-seeking question on this one? What it is, interest rates charged by the Reserve Bank on who? Commercial banks. So you've got the central bank and then you've got your commercial banks, the ones that we interact with, because we don't interact with the central bank or the Reserve Bank. We interact with commercial banks on a daily basis. We're transacting, we are borrowing money from them, we are saving money with them, etc. Right? So these banks that we are engaging on a daily basis, we've got Standard Bank, but I know outside of South Africa they go by Stanlib. It's Stan. What is it? I forget. Stanlib is something else. It's an investment bank. I think it's Sasfin. No, that's something else as well. Stanlib. No, I can't remember. But you get it, right? Then we've got ABSA here, which goes all over the world, is Barclays, or whatever you want to call it. I think pretty much in Africa we've got this one. We've got FNB, First National Bank. In other countries, it might go as Rand Merchant Bank. That's the big boy of them, Rand Merchant Bank, and so on it goes, right? So let's say, for example, let's focus on the US for now. Because I mean, who doesn't know anything about the US? We consume everything. So with their banks, they've got Bank of America, right? Bank of America. What other banks have you heard? Citibank. Come on, Citibank. Yeah, these are the ones that I can think of from the top of my head, right? These are commercial banks. So
Choose back in US or UK.
in the US specifically, for now,
Yeah.
right? Those are the banks that we want to mention. So so in this instance here, we've got, let's say, the central bank. These guys also borrow money. So the interest that this guy here, the central bank, charges affects us as well. It'll affect the interest rate, right? Nice and clear? Reserve requirements, also known as SLR. I forget what SLR is. I don't think you can Google the term. I forget it because sometimes you'll see them saying SLR. But essentially what they're talking about is reserve requirements, right? Reserve requirements are the portion of deposits that banks must hold in cash, either in their vaults or on deposit at the Reserve Bank. A decrease in reserve requirements is expansionary because it increases the funds available in the banking system to lend to consumers and businesses. Where was I? An increase in reserve requirements is contractionary because it reduces the funds available in the banking system to lend to consumers and businesses. The Board of Governors has sole authority over charges to reserve requirements. The Fed rarely changes the reserve requirement, but they do. They changed the reserve requirement back in 2020, right? Because the economy was in distress, right? The economy was in distress. So they lowered the reserve requirement. In other words, I deposit $100. You know that this is a liability on the side of the bank. It's not an asset, it's a liability because you are borrowing them money once you deposit. So they need to put this to work. So what do? They use a system also called fractional banking reserves. There's a fractional reserve bank, and it's fractional banking reserves. So how that works basically is, fine, $100 has been put in. Let's focus firstly maybe on this one, reserve requirements. They're going to lend out this money, but they can't lend the entire $100. So let's say the requirement by the Reserve Bank is 10% must be in the bank's vault or on deposit at the Reserve Bank, right? So they only are allowed then to use $90 to do what? To go and borrow it out, to give it to others, not borrow it out, but lend it out, right? In the form of, it could be a home loan to somebody, a short-term loan, it could be vehicle finance, whatever it is. It could be funding a business, it could be capital, right? So on and so on and so on. What is the 10%? The value of the 10% in this instance, it would be $10. Am I right? Yeah, $10. So quite, I would say relatively low, the requirement. Now, if things are, well, if based on the economic indicators that we briefly looked at, labor data, all those data, CPI, etc., all of that, if that data is suggesting that the economic wheel is turning too fast, there's too much money supply, this is one of the things that they could adjust as a monetary policy tool. They could increase this, let's say, to, let's say, 40%. So a commercial bank is no longer required to hold $10 on deposit, but $40 now. So now there is basically now going to be less money in circulation, so to speak. It's no longer going to be $90, but it's going to be $60 available in the banking system. I haven't lost you at this point, right? All on the same page?
Yes.
Okay. Hey, only one yes. Let's see. Who do we have here?
Yeah, it's understandable.
Are we all good? Are we all good?
Yeah, we are
Yes.
following.
Okay. Glorious FX. Where are you, my sister? Is she here? My sister is not here. Are you here? Nope. Okay. So now, remember I mentioned fractional reserves. What that is, put simply, I'm going to oversimplify it. Now, let's say they're working with $90 to borrow out. Technically, it's not. It is way more than $90. They are allowed, with permission, of course, from the central bank, there's a tool or fractional banking reserves, depending on what it is. It allows them basically to, let's say, photocopy this $90 and let's say photocopy it 10 times. So technically, they can borrow the same $90 10 times. There's only one $90, but they are replicating it 10 times. Okay, so it's not 90. It would be then be how much? That would actually be in the system, in the banking system. 900. 90 times 10 is 900. Am I right? Maths has never been my strong point, but money I can count. Right? 900 is basically then is what is in the banking system that is going to go out there to businesses and households in the form of loans. And that's basically how banks would make money. Right? That's how they would make a profit. Any question? All good. Let's move on. I know it's late. My apologies. Say I was a little far ahead. Somewhere to go. Open market operations, alternative to taxation. The buying and selling of US government securities, right, has been a reliable tool. This tool is directed by the FOMC and carried out by the Federal Reserve Bank of New York. I've never really taken the effort to figure out why specifically the Federal Reserve Bank of New York and not Philadelphia, honestly. And every new class I get asked for years the same thing, and I still haven't actually bothered actually to find out why. But that's, if the open market operation is basically conducted by New York, right, on instruction by the FOMC. So this is basically that buying and selling of those bonds, right? Interest on reserves is the newest and most frequently used tool. But okay, before I go there, remember I said China reserve requirements, they dropped it, right? I think they did that yesterday. So dropping that reserve requirement, and which is something they haven't done for many years as China. I think it really highlights the economic challenges that they're facing right now. So dropping that requirement is quite expansionary. We can definitely see that they're trying to stimulate the economy, which hasn't really gone back to those pre-pandemic levels. They are in a disinflationary situation, which is very concerning because it's starting to remind me of Japan, right? China, where are you? China. I just saw it down. Okay, there we go, China. The inflation rate, I mean, is quite low. The inflation rate is very low. And so I think you can measure the speed of the economy also by looking at the inflation. Your inflation needs to be constant, if that's the right word. It needs to be in a natural range, like I said earlier. Where is their graph? I'm trying to find it. It's not popping up. Okay, let's refresh. Definitely that's not good because that simply means that your economy is seizing up. Let's look at it on a wider scale. We can see what would be the average here. Can I find it? Maybe not quite, but it's a good enough graph. Let's see before 2020. They were playing within the 1 point, mid one, let's say high ones and low twos, which is stable, right? High ones with an occasional high twos, right? High ones, low twos, that's quite normal for developed economies, right? For developed economies. And then it spikes in 2020, right? It spikes and then it just collapses. It tried, but they're really struggling. It's definitely not looking good. So they are trying to stimulate the economy. Now, this stimulation, should it work, what other countries would benefit from this? Sure, I would say everybody gets to benefit, but who is one of their strategic partners? Who's one of their strategic trade partners?
US.
Yeah, sure, the US, but I think the US would celebrate the downfall of China.
Or Japan.
Because, I mean, it's not like the US or China relies on them. If anything, the US found themselves actually now importing way more than they thought they would be importing from China, right? And they don't really like them, but that's what it is. Australia stands to benefit because China rather, is the largest importer of that iron ore and coal coming from China. So those two are tied at the hip. If China's downfall would definitely hurt Australia, put simply. So if this stimulation works, then we would definitely see a strong economy as well in Australia. Does that make sense?
Yes, come on.
Okie dokie. Interest on reserves is the newest and most frequently used tool given to the Fed by Congress after the financial crisis of 2007 to 2009. Interest on reserves is paid on excess reserves held at reserve banks. Remember that the Fed requires banks to hold a percentage of their deposits. Remember this, right? Where am I? In addition to these reserves, banks often hold extra funds on reserves. The current policy of paying interest on reserves allows the Fed to use interest as a monetary policy tool to influence bank lending. For example, if the FOMC wanted to create a greater incentive for banks to lend their excess reserves, it could lower the interest rate it pays on excess reserves. Banks are more likely to lend money rather than hold it in reserve, so they can make more money. Creating expansionary policy. In turn, if the FOMC wanted to create an incentive for banks to hold more excess reserves and decrease lending, the FOMC would increase the interest rate paid on reserves, which is basically a contractionary monetary policy. Is that one clear?
Yep, as clear as the blue skies.
Thank you. Right. So, yeah, I think it makes sense. If I'm running a bank and they say, listen, you need to hold on to 10%, but actually I'm holding more than that. Maybe I've got an extra 10, so I'm actually holding on to 20%. And I'm being paid for that excess reserve for keeping more. It's easy money. But once they lower that interest rate or make it zero, then there's no incentive for me to hold on to that money. It's a liability. So I need to make that money work so it brings back a return. That's simply how it works. Now, the one that we got to go on and on and on and on about is interest rates, and it's going to be inflation. So to understand the context of the financial markets, the current context of the financial markets. But for us to understand that, we have to go back into time. We have to rewind the cassette because you've just gone into a movie theater and the movie is halfway. It's playing. So it won't quite make sense. We have to go back. Let's rewind the tape, at least as far back as, let's say, 2019, and work our way to where we are, right? And understand exactly how did we get to this theme of interest rates and inflation. So tomorrow, we will talk about the different measures of inflation. We will talk about interest rates as we know them and how they affect the economy, and of course, inflation, which is part and parcel of the economy. Are there any questions? Unfortunately, the time, I think people have got work. For some, it's wee hours of the morning, possibly. So I think we should leave it here for today and carry on where we left off tomorrow. Any question at all?
No, thank you.
No question? Nice and clear? Nice and easy?
Yeah.
Okay.
Yeah.
Fantastic. So I'll see you tomorrow. We're going back to our usual time, 6:30 p.m. South African time. I promise I'll be on time to be on time too. Shaya this, Shaya that.
Shaya.
Thank you. Take care. See you.